Welcome to our first-time homebuyer class. My name is Cal Anton. My partner John Thompson is here.
Hello.
We are generational mortgage advisors, working with those people that are first-time homebuyers, those looking to trade up or down, and finally, we're both reverse mortgage specialists. So welcome aboard to our Smart Homebuyer class. For those of you that didn't hear already, if you have a question, please put it in the chat room and we will answer it as soon as we're done with the class. Take it away, John.
Perfect. I'll get started. So thank you all for being here. You'll notice we actually call it the Smart Home Buyer as opposed to first-time home buyer. And the reality is that people may buy 4 or 5 homes in their lifetime, but that is not enough practice to really know all the ins and outs, and it's changing all the time. This class is designed for what we call smart home buyers, because we don't care if you're a first-time home buyer, second, third, fifth, your last home. You're still stuff to learn all the time, and we're in education. So we appreciate you taking the time to be here, and hopefully you'll learn something and pick up something here today you can share with your clients. So I think you're all familiar with this logo, and you may even know the little trick that's in the logo. So if you'll see there under the FedEx on the right-hand side, you'll see a little arrow pointing to the right. If you've never noticed that before, you're going to notice it every single time you see the FedEx logo again on the side of a truck or envelope. And if you've seen it before, then of course it's kind of old news, no big deal. But if you've never seen it before, something's been triggered in your brain, which is called a reticular activator. The reticular activator is that piece of your brain that says, oh, I learned something new and now I'm going to pay attention to it. Before that, it was never there. It didn't exist. It was never there before. So we hope that you learn at least 1 or 2 things today that will trigger your reticular activator, that you'll learn that you can put into your toolbox to share with clients, your family, friends, associates, and make the place a better world in our real estate community. So we start with the big why, right? And so when clients come to us, every conversation starts in the same way. So with Cal or myself or anyone on our team, we want to know why people are looking to do what they're looking to do. And it seems really basic and really obvious, but when you really ask the question, well, why are you thinking about buying a home today? And pause, people have to really think about it. They have to articulate why. And sometimes they don't really have a clearly formed opinion. So we'd always advise you to ask your clients why, like what's going on in your life? Why now? Why not next year? Why not last year? And get that kind of drilled down a little bit deeper. And you'll be surprised what you learn and where it comes from. And then you can position your questioning and your statements around those sort of the answers that they've given you. All right, so when we talk about, there's obviously a financial implication here. And so putting aside all the other reasons on real estate, one of the basic questions is financial. We talk about, should I rent or should I buy? And so we have a very simple example that I'm going to take a quick moment to kind of go through. So in this example, we're going to compare buying a $500,000 home. There's not a lot of those around here anymore, but a $500,000 home. We're going to assume that maybe you've got $50,000 that you've saved up, or maybe you have a gift coming in. You could keep renting and use it and have that $50,000 kind of grow over time. Or you could put 5% down, pay your closing costs, which leaves you maybe $15,000. So on the left-hand side here will be the idea of renting, and maybe you have a little rent increase over time and so forth. So the left-hand side shows what's going to happen if you're renting over 10 years, over a 10-year period. The right-hand side is showing again buying. So buying a home at $500,000, putting down $25,000. So you borrow $475,000, and here's all the payments, right? So we know that on the left-hand side is our lease payment of about $2,300 a month. On the right-hand side, we have the cost of a home, which includes taxes and insurance and mortgage insurance at just under $3,200. There is some tax benefits there. And so at the end of the day, this is still a higher expense by about $190, maybe call it $200. So if you chose to rent, you could have your $2,300 payments. You could choose to save the cash flow difference, which most people would not do. But you still have your $50,000, and that money is growing over time. And so here's what it looks like over a 10-year period. You would have paid out $326,000 in rent. That's a lot of money, $326,000 in rent, but your cash would have grown to about $74,000. So that's a good thing. On the right-hand side, we have buying the home. I got $3,200 payments. I got a little bit of money left over that I can invest. What's this look like? Right, so we have a total payments of about $395,000, which includes the $15,000. But what happened with the real estate that we all know? Real estate grows, right? So you have appreciation over time, and actually ultimately we're ahead by about this is $255,000 is our net worth. The net worth is the difference between the value of the home and our mortgage liabilities at $378,000. So you're ahead by quite a bit of money there. right, so here's kind of the payment kind of summarized again, $2,300 compared to our mortgage payment. The cash that went into the deal, the $191 in cash plus the $50,000 minus $15,000. So at the end of the day, you have an increase in net worth, your wealth, of about $181,000 over 10 years. So that's a very basic way of kind of helping someone understand the rent versus buy conversation. And we have that with most first-time home buyers that kind of come through. Intuitively, though, Cal and I both know that people kind of just understand that. So now we're going to kind of look at one that's a little bit bigger. This was a $600,000 home over a 10-year period versus a little bit higher rent and so forth. And I won't go into all the detail there. But if you play this out over 30 years, actually, you come out ahead by about $1.5 million. So it's not just a one-time decision, it's a multi-year decision. Over 30 years, that same thing is worth about $1.5 million. Okay, so when we talk about sort of the questions that we go through, and the basic questions we ask clients are here. Why are you thinking about buying a home today? Will your income be increasing or decreasing over the next 5 years? And why is that important? We want to know because people look at cash flow. We all live lives of cash flow. And if we know that income's going up, and they need to stretch a little bit today, we can show them how it may feel better in 3 or 4 years, and that might help them make a decision. That's one decision. Now, if income's going down, right, we have the opposite decision. Maybe you need to be more conservative. And then the last question really ultimately is, how long do you plan to keep your home? And that's an important question because you want to recoup the cost of buying a home. You need to understand how long they're going to be in it in order to figure out what type of mortgage to put them in. And of course, if they're thinking of moving in a couple of years, is this the right time in the marketplace, which is where you guys kind of come in. All right. So lenders look at what are called the 5 C's to help make a decision. So if you're familiar with the loan process, you're obviously familiar with it, you're in the real estate industry, but you may not really understand what lenders look at. And they look at what are called these 5 C's. Sometimes it's the 4 C's, but it's character, capital, capacity, credit, and collateral. So look at the character. You know, what kind of job do they have? What do they do? What's their position in the community? Capital is kind of how much money they have available, their savings, and they have a good savings pattern. Capacity is their income. You know, how much income do they have? How much borrowing capacity they kind of have? Credit's their credit history. You know, we're all very familiar with credit scores, and credit scores are a quick snapshot into time. That FICO score tells you theoretically if you're good or not so good, and that may or may not be fair, but that's kind of what it is. And Cal's going to talk more about credit scoring in a little bit. And then collateral is the real estate. It's the value, it's the security for the loan. So all those different things mix together to make a determination if a lender should make a loan or not. Okay. So Cal, I think we're going to jump in and do a quick example. Okay, let me get this open.
This is just to give you guys an idea of what we're looking at to get a client qualified. And so it's a simple spreadsheet, and why don't we just go ahead and use a $650,000 purchase price.
Okay, so we'll put in $650,000. And again, we do this with every client, and this is our baseline of how someone's qualified. We think it's helpful for you to see this. We share this with our clients so they can just kind of see how lenders look at the numbers.
And then, and then we'll show them, John, the debt to income ratios. Yep. We do this with all of our home buyers so that they really understand, and we're going to talk about this later, what you qualify for and what you're suitable for, okay? But let's say they make $120,000 a year, okay, and maybe a car payment of $250, and credit card debt maybe $20 a month.
Okay. Student loans, we replace it for student loans, installment loans, boat loans, airplane loans. Spousal support would be in here, all that kind of stuff. All right.
Maybe put $100 for student loans since a lot of our buyers have student loans.
Sure. We know there's a lot of student loan activity out there as well. And so the spreadsheet gives us the option to have different kind of down payments, Cal. So what kind of down payment do you think we should look at?
I think we're going to go 5% conventional.
Okay. So we're going to be in this column kind of over here, right? So we're going to kind of go through this column. So what this gets us to a couple different things. I'm going to walk you through and explain just quickly what the different numbers are. So you got here's our down payment. So a 5% down payment on 650 is $32,000. Here's our mortgage amount of $617,000. Here's the mortgage payment based on 3.25. Rates are a little lower today. What do you think, Cal?
I think we put 2.875.
Okay, fine. So 2.875, you'll see then the required payment is $26.51, $26.62. This next figure is what's known as mortgage insurance. We could have a whole class on mortgage insurance, but essentially, it lets you put down less than 20%. And then you know what?
It's actually lower now. It's about 40.
Let's update that a little bit.
Yeah, it's about 45.
Right. Okay, so
I
there we
found
go.
lenders that can give us in the 20s too these days. But that's a different.
Okay, let's just be safe. Then we have your property taxes broken down monthly. And then we have homeowners insurance. That's your fire, your theft insurance, all that kind of stuff. So in this example, $650,000 home, 5% down is about $3,600, a little bit over $3,600 a month in total payments. Okay, you want to go to the debt ratios?
Yeah, now look at your debt to income ratios. So the top ratio is your front end ratio. That's basically your new housing payment, the $3,624.98, divided by your gross annual income, and that gives you your debt to income ratio. Now that's good right there. 36 is good. Typically, we like to see that between 33 and 38. Wouldn't you say, John?
Yeah, absolutely.
That means that you're spending about, a third of your gross income, monthly income, on your housing payment. We can push that number probably close to 40 if we have to, but to be safe for our clients, we like to see that number. The bottom ratio is your total payment, that plus any consumer debt, which includes car payments, credit card debt, student loan debt, any other installment debt, divided by your monthly annual income, and you've got that back end ratio. Now that ratio can be between 38 and 45. 45 is the highest. Lenders like to see it. With FHA products, other lenders, we can push it to 48. But in a perfect world, we're between 38 and 45. So this is a very well qualified client right here. Their ratios are right in line, and this looks like what a comfortable payment and qualification would be for this client.
Yeah.
If you have any questions, or thoughts about this, type it in the chat room. We can go through it later. And
then sometimes people ask the question, okay, great. So how much what's my maximum? They like to have a range, right? And so I would say the range for this person is probably low of $600,000 might be ideal. And let's put in 725,000.
Yeah, I bet they can go to 7.
And so you got to 40 over 44. That's probably the top end of where someone would feel comfortable. So the range for this buyer is, 600 to maybe 725. And that's how we kind of work it. And then if they say, well, great, we have 20% down, the numbers over here you'll see are 33 over 36. So those are good ratios as well. They could probably push a little bit further if they had, a little bit more room to go. All right. So
John, push over to the FHA. Let's talk about that one really quick.
Yeah, sure, of course.
So FHA, as you know, you can go down with 3.5%. Okay. That does have upfront mortgage insurance. But look at this client here. They would qualify for the 3.5% down. So as you see, in addition to their down payment, they get upfront mortgage insurance, and that's added to the loan amount, as you can see. Then you've got your payment. Mortgage insurance is higher on FHA. So click on that one, John.
Yep. That
is 85. That's not going to change. Whereas on the conventional, you can be anywhere from maybe 20 to 45 on the monthly, but that's there. The taxes are the same. The homeowner's insurance is probably the same. We're using a formula up there of 3% of the loan amount, which is why that's a little bit higher. But then you've got your all-in at 37, 75, 15, and look at your ratios. Now I can tell you this much: on FHA, there's two pluses. Number one, they can have a lower credit score. They're more tolerant with a lower credit score because the product is there to help your first-time home buyers and people with some credit challenges. And number two, what was the number two I was going to say? I just lost my train of thought. It's the credit score and the interest rate. To make up for the fact that the mortgage insurance is higher, the interest rates do tend to be lower. And today, instead of being 2.875, I'm going to wager a guess that FHA, maybe 2.375.
2.375, somewhere there.
Yeah.
And
Go ahead.
And I would only add to that, Cal, that and the other thing that FHA allows you to do is it allows you to push the debt ratios higher. You can go up to 50% versus the 45.
Right. Yes, exactly. Exactly.
Sean asked us to run numbers at sort of half that income because, as he points out, not a lot of first-time home buyers are making $120,000 a year, which is a fair comment.
Perfect.
So let's look at maybe a single person earning $60,000, and where does that get them? And so if they still had this kind of debt, even at 450, 5% down, those ratios are too high. The FHA is still too high. Let's see, let's go the other direction.
75. No.
Even 375 is probably going to be pushing it. The challenge there at the end of the day, so let's see, 325. 325 works, or
I
we
think
depend on.
350 would work, John.
Yeah, it probably does. But then we also look, and so that at that point we start talking about home loan action planning. Okay, is it better to take a little bit of cash and pay off cars? And we start to get the creative part of what we get to do. Maybe it's better to pay off the cars. Maybe it's better to wait 6 months to save a little more money and so forth. So that's where that conversation kind of comes in.
Yeah.
All right.
That look good, you guys? Any other questions on this? And you can always call us, and we would love to do this with any of your clients or for you. You want the?
So this is just a very quick rough idea. You sort of multiply the income by about 4.4 times. So you can kind of get a rough idea. If someone says, I make 100 grand, what can I do? Okay, so maybe it's, there you can see it's maybe $550,000, somewhere in that range. Okay, so don't count on this. It's not in depth, but it's a guideline.
Yeah, and it depends on the interest rates as well. I'm going to answer Sean's question really quick. He says, do we want the front end and back end to be below 45? Yes, in the perfect world, yes. If it's FHA, they can push higher to 50 on the back end. Okay. Okay, let's look at this. Alphabet soup is what we call it, and we don't go into much detail, but when we're teaching our first-time home buyers and our smart home buyers this class, we like to let them know there's a lot of these acronyms that are going to be thrown at them. FHA, we explain what that means. Fannie Mae, Freddie Mac, Ginnie Mae. What's a GFE, a good faith estimate? What's the CLTV, the LTV, loan to value? So it's just a kind of a little sampling of kind of the different terms that they may be faced with, and we want to make sure that everybody kind of has a good idea. There's all kinds of different mortgage types, and this is kind of our little risk pyramid. So we ask them, you've got your ARMs, those are back, as you know. You've got your 1 month ARMs, your 6 month, your 12 months. Those are a little bit more aggressive for the client that's going to want a little bit more aggressive loan with a lower payment. We've got your moderate stuff with the 3-year, 5-year, 10-year, 7/1 ARMs. And then you've got, of course, your fixed. I don't know that 40 years, I haven't seen 40-year around.
Not really around anymore, other than the private money world where they're still around. But as you all know, everyone's going into the fixed rate market this day, other than in the jumbo space where ARMs are still a little bit pretty popular as opposed to
exactly. And really the difference now between a 15-year rate and the 30-year rate is it's insignificant because the rates are quite low as it is. So what I want to talk about now is the different ways that you need money to close a purchase. And this is an important conversation we have with all of our clients because especially young people and first-time home buyers, they think, okay, I've got my $25,000 for my down payment, I'm done. And we like to caution them and remind them that in addition to their down payment funds, there are 3 other ways that they are going to need money in order to buy a property. So the first place that they're going to be needing money is those third-party one-time costs and fees. Those are your escrow fees, your title fees, your appraisal fee, your home inspection fee, your termite and pest inspection fee, underwriting, processing, all the third-party stuff that they're just going to pay one time because of this transaction. You, of course, as the experts, are going to tell them what the seller is paying and what they're paying, but they need to have an idea that they're going to need a chunk of cash for those fees as well. Then the second way that they're going to need to spend money is going to be on the prorated property taxes, the upfront insurance, mortgage insurance, homeowners insurance that they're going to need to come up with at closing. And then the third way that they're going to spend money is going to be on impounds. Now, these are not fees. For any borrower that's putting less than 20% down, most lenders are going to require them to set up an impound or escrow account. And what that basically means is that the lender is going to hold their property taxes and insurance on a monthly basis, and they're going to pay it the 2 times a year that it's due. Now, what's important to note is that every month is a different time of year that we're closing, that we will be requiring how many months up front. So for example, if a client is closing today in August, most lenders are asking for 8 months up front. 8 months up front. And that could be, if you $500 a month for property taxes times, 8 months, that's another, $4,000 that they're going to have to come up with, and that could be surprising. We typically tell everybody to think of it as 2% of the purchase price in addition to their down payment. Next, we've got all types of insurances that we like to just mention. As lenders, we sell no other products, but we like to make sure that there's education out there. So we've talked about mortgage insurance, and as you guys know, different for FHA than conventional, but most loans with less than 20% down payment will have some sort of mortgage insurance. Of course, you got your homeowners insurance. That's where we bring in our experts that are homeowners insurance experts, but you need that to protect the home if it's a single family, and the walls in if it's a condo or townhouse. There's also these other insurances called mortgage protection. We call it life insurance, and those are things that maybe buyers want to think about to protect their house. Then, of course, you've got your title insurance. You got your lenders and your borrower's title insurance. So those are just little things we like to keep, make sure that everybody knows that there are different types of insurance.
Oops. Sorry, my fault. I'm here.
No, go ahead. You're good.
Yeah. All right. So I'm just going to just touch on quickly. There's, we often get asked, are there, really unique programs? What are some special things I can do? First-time home buyers and that kind of stuff. There's a lot of different programs out there. The reality is the way you qualify for most of these is the same, with the exception of some of the down payment assistance ones and that type of stuff, where you have to qualify based on your income or maybe sometimes your territory. So not a ton of time to spend here, but there are down payment assistance programs. It depends on your income. It depends on those kind of criteria. So you just got to check with each lender as you're going through those, and know they're out there, but they're not all they're cracked up to be at the end of the day is our word of caution.
Yeah, exactly. All right, let's talk about credit scoring of FICO. It does predict the statistical chance of a consumer becoming 90 days late or more on a particular loan obligation. Each score is specific for each bureau, and as you know, there are 3: Experian, TransUnion, and Equifax, okay? Scorings range from 350 to 850. If anybody's got a 350 credit score, I'm happy to talk to them, but they're not going to be purchasing for quite some time until we can help them fix that. Online sources, I want to caution you, Credit Karma, etc. Those are good to have because it keeps you in touch with what's going on your credit, but they are not the same as the scores used by mortgage lenders. If you want a true and more accurate look at your credit score, each bureau, you are, as a consumer, entitled to 1 yearly examination for free and without any hit to your credit score from each bureau, okay? So you would go to www.annualcreditreport.com, and you can get it from all 3 bureaus. My suggestion is you do it a couple times a year, go to each bureau throughout the year and pull it just to make sure that everything is where it should be. If you have any questions about that, feel free to email us. Happy to go through that. Credit score is a big game. It used to be that you got all kinds of points for having a good credit score. John, am I wrong? Today,
Yep.
nothing but being penalized for any score under 740, 750. And even at the 720, 740, a lot of lenders are putting a quarter-point hit just for credit score, and because they can. But there's, what it looks like. Obviously, if you're at 720 to 850, you're in a great shape, excellent shape. Grade is 700 to 719. You're good at 675 to 699, and then on downwards. I think, John, am I correct in thinking that FHA, you still have to be at least 620? Between
620 is minimum for most lenders. I've heard there's a couple lenders going down to 580, but don't quote me on that.
And by the way, if they did, the rates, it's going to reflect.
It's going to be ugly. Yeah. You'd want to do some work on the credit. Yeah. We've just started a program where we're partnering with a nationwide company to be able to help people, not necessarily fix credit, but it's more of an educational program where they can do some of the work themselves. So anyway, reach out to us if you have clients that need to work on credit a little bit and get in a better position to buy down the road.
And, I'm just going to point out too for your clients that when they ask you, well, I want to get pre-approved, but I don't want them to put my credit score yet. Yeah. The reason why it's better to know now, so that they have time to do something about it, because consider this, once they get pre-approved and you've pulled their credit report, most lenders will not let you repull credit for at least 30 to 60 days because they don't want you to manipulate the score. So it's better for them to come beforehand to their lender, get fully pre-approved, so they have time to maybe pay down a debt and raise their credit score. So I just want to keep that caveat.
Yeah. At the bottom, you see that little pie chart. This doesn't come often, but I think we all are aware how important credit is. If you're ever interested in knowing the makeup of your credit score, it's those percentages down there. It's, the orange one being the large ones, your payment history. Obviously, if you pay on time, it's better. But the next one is utilization rate. That 30% on the right is utilization rate. What that means is it's the percentage of your credit you're using. So if you have a $10,000 credit card, you have a $5,000 balance, that's obviously a 50% utilization rate. Mm-hmm. You want to be under 30%. Right. So one of the ways people can massage credit a little bit is actually increasing limits sometimes helps, because if you went that same example I gave you of $5,000 to $10,000, if you increase your limit to $20,000, now the $5,000 is only 20%. Your credit score would actually go up. So anyway, those are just a few tips that we share with people as we go.
Right now, as I mentioned earlier, we do a lot of talk about affordability versus suitability. So if you remember in our Excel spreadsheet that we shared with you earlier, our goal was to find out what the lender is going to look at to analyze whether or not they can afford the home. Now, just because they can afford an $800,000 purchase, if you look back at the spreadsheet, you saw that the all-in payment was $4,000 a month. So we do a lot of conversation about, okay, what is your goal? I know that we say you could be between 38 and 45% on the DTIs, but what's comfortable for you, for your lifestyle? Is it $4,000? Is it $3,500? Is it $2,500? So we have that conversation too, to make sure that we can understand where their comfort is. And then their actual target purchase price ends up, from our experience of doing this, somewhere between the two. And so that's basically what's suitable to them and what's affordable to them.
One of the other educational components we kind of go into when sort of helping understand the psychology of buyers is to try to help them separate the emotional decision from the financial decision. You, when I say you, I mean real estate professionals, get the opportunity to participate in a really fantastic experience for their buyers, right? And it's very emotional and so forth, and that's great. We're on the financial end, and while there's a lot of emotions tied up around money, the decisions around money ideally are not based in emotion, right? So we try to help people understand this difference between house and home. So home is the experience you have when you live in a home, right? It's your family, it's your hobbies, friends, neighbors, relaxation, the privacy, and that kind of stuff. So it's the emotion, it's the experience you're having in your home. So what's on the other side? The house is really the logic. It's a physical shelter. And all the things that both go into a house are really things like appreciation and tax benefits, diversifying your assets. You know, it could be a place to work, especially now with COVID. I mean, you know, people are starting to view this thing asset a little differently, and lifestyles I think will be changing a lot over the next couple of years. Credit mortgage. So we share that with you only because, again, as we try to separate the decision, we want people to make the mortgage pre-approval, pre-qualification decision in advance of really looking for homes, because they might end up out there and making an emotional decision, and then they get in trouble on the financial side. All right.
So we know you're the experts in the home buying step by step, but we're going to share it with you anyway. We share it with the clients. So obviously they first get pre-qualified, and then they get a pre-approval for their loan. They're going to select one of you amazing agents. You guys are going to identify some properties that meets their needs. You're going to write up an offer for a purchase. The offer will get accepted. We'll opening escrow and title. Inspections will be scheduled. If you know, they'll do their job right, and we will remove the contingencies. Then they sign loan documents and deposit the funds into escrow. Final walkthrough, and then congratulations, they have closed escrow and own a home.
Woohoo!
Yay!
Yay.
So this is really a question we'd ask you guys. How is the market doing? What do you think? Does anybody want to chime in? If you do, unmute and chime in. What do you think the market looks like? We think it looks good. We think it looks good, but John's going to go through the stages of kind of where we are.
Yeah, you know, it's we don't know where the market is either. There's a lot of great things. We know there's very little inventory. It's not our area of expertise, so we can only really speak anecdotally. Obviously, there's multiple offers on properties, and there's a lot of enthusiasm and so forth. What I'll point out is that, you know, all markets go through cycles. It doesn't matter if you're buying gold, soybeans, real estate, or tech tools, whatever it might be. It doesn't matter. So this is what's called, you know, an investor chart, and it's just a cycle. So things start here on the left-hand side with optimism, and as the market starts to go up, people get excited. There's thrilling, there's euphoria. If we pass the point of the top, and no one really knows when this is, but this is actually the point of maximum risk, right? It's just we don't know where this top is. As you pass the top and maybe you've turned the corner, maybe people start to feel a little anxious. Then, of course, there's denial, fear, desperation, panic. Finally give in, well, it's not going to get any better. This is horrible. And, you know, now I'm depressed about it and all the rest of it. This is where there's opportunity, right? So back in 2007 and 8, when the market, you know, began to fall apart, if you'd, oops, I don't know why I'm skipping ahead. You know, if you'd known that, you obviously could have made some different decisions at that point, you know, and then it returns back to where it is. Oh gosh, we're off the bottom, and now we feel relief and we have optimism. And guess what? It starts all over again. So we didn't know where it's at, but my guess is it's somewhere over here. Hopefully they'll continue, but it's going to change. And maybe it's this year, maybe it's next year, maybe it's 5 years from now, but we don't know. But consumers are thinking this as well. So it's important to address it and be ready to answer the question in the way that you think is the best way to answer the question. So cost of waiting, I'll go through this very quickly. I think we all understand that the cost of waiting can be very expensive, right? So people are like, oh, I'm just going to wait a year or two and maybe the prices will drop. This example, and you'll see the rates are a little bit older. I have a 4.75 and a 5.25 rate. This is simply the idea of, okay, so if I waited a couple of years to get, you know, a price reduction of maybe 10%, but rates went up 0.5%, what's it mean long term? Well, the bottom line, it means quite a bit. You save $236 in payments, but you lost $225,000 in wealth by waiting that couple of years because of the growth of appreciation over long periods of time. This is another example. Let's see. Yep. So this is a 10% drop versus a 1% change in interest rates. We went from, in this example, 4.75 to 5.75. You know, you save $75 in payments, but you lost $250,000 in wealth. So, you know, and that works at almost any price point. It doesn't really matter what the price point is or what the interest rates are. If you make the assumption that rates are going to be higher down the road and prices drop, this will always play out where there's a benefit of buying now.
So we're going to talk a little bit about getting pre-qualified versus pre-approved. And this is how to get your offer accepted. As you know, being pre-qualified is basically a conversation with the client. So they'd call their lender, they would have a nice conversation. There's no obligation, it's very informal. And they tell us a few numbers, and then we tell them, well, it looks like, in my opinion, you could be pre-qualified for $600,000 with 20% down. And it's basically mostly verbal without any documentation. We do not recommend that at all, especially in today's market. In order to get an offer accepted, as agents, I wouldn't get in the car, so to speak, with anybody that wasn't fully pre-approved. And as a matter of fact, a step further, get the actual desktop underwriting done. And so a pre-approval is actually a formal commitment from a lender. So we've now not just spoken to them, but we've got the application, we've pulled their credit, and we have all their homework in. I's are dotted, T's are crossed. John and I take it also to another level. We do a desktop underwriting to make sure that it will be smooth and easy going through. And once the offer is accepted, except for updating some pay stubs and making bank statements, we're pretty good to go. Here's a little bit about the loan process, a little different than the purchase process, but kind of the same. Again, you first get pre-qualified conversation, you fill out an application, we collect documentation, check credit, and get them pre-approved. Once the purchase contract comes in, we get them originated, get disclosures out, we order the appraisal. Escrow, title, and home insurance are all ordered and set up. The file goes into underwriting. We get our very first conditional approval. Once that comes in, we gather the conditions. And those, as you know, are conditions needed from escrow, title, insurance, and the borrowers. Once that's all in, we get the closing disclosure out. That gets the 3-day clock ticking, and we can sign documents 3 days later. Once they sign documents, they deposit funds in escrow, and we close escrow.
Woohoo! Congratulations again.
Pretty simple. And it can be simple if they've done their work up front. We're just going to talk a little bit about the difference when your clients ask you, bankers, brokers, what's the difference? John, you want to talk a little bit about that?
No, it's fine. So I've been in the business 31 years. Cal and I have been together now for about 11 years. And so I've been across all the spectrum of different lenders. So when people ask this question, you have the banks. So the banks are the Chases, B of A's, Wells Fargo's of the world. And there are good people at all different lenders. There are great lenders in all these different, what we'll call channels, right? So the bank, you understand, the bank is the bank on the corner. They have their checking account, their savings account there. At the end of the day, banks have their products, and that's kind of what they sell. And if they are competitive at the time, then they're competitive at the time. And if they're not, then they're not. A mortgage banker is a company that funds their own loans. These are companies like Quicken Mortgage, you got Prospect Mortgage, Caliber Home Loans, to name a few, Sierra Pacific. There's some large mortgage bankers that fund their own loans, and those loans are sold off into the secondary market. Sometimes they act as a broker as well, sometimes they do not. Again, good people there, but they have their products and that's what they sell and so forth. Then you have brokers. So we, about 2 years ago, moved into the brokerage world from the mortgage banking world. It was an intentional move to help our partners and our clients. So in the brokerage world, we view it as really having the largest distribution and availability of products out there. So we can take loans to banks, we can take loans to mortgage bankers, we can take loans to other sources that are out there. And our job ultimately is to help someone make a good financial decision amongst the choices they have. And so that's kind of the three different things. And again, there's good people all those areas, and there's positives and negatives in all areas. But that's kind of where we're at now. Anything you want to add to that, Cal?
No, but I'm going to just answer Sean's quick question.
Okay, thank you.
Back up a minute for time frames. That's a great question, Sean. Thank you. So between the opening packet and disclosures, if the client is fully pre-approved, from the time we get our purchase contract, And actually, it's also reliant upon escrow. Escrow has to provide their escrow fees in order for the lender to accurately get out the disclosures. So once we receive the purchase contract and the escrow fees, we're typically in position to generate our loan disclosures, sometimes anywhere from 6 to 12 business hours. Once they get the loan disclosures, the moment that the client signs those, the appraisal is ordered and the file is immediately submitted into underwriting. That's our process because we don't have any delays. We already have the package ready to submit into underwriting. Once it goes into underwriting, it comes out. We order the CD typically at loan approval because, again, the CD can't be ordered without the insurance and the escrow fees and documents. So once we get that, we try to stay ahead of ourselves and get that CD out. And it really is, once they have insurance, they can get the CD out at approval. And then there's a 3-day wait. So the CD goes out, it's signed, there's 3 business days that the client has to wait before they can sign loan documents. And then, as you know, if it's a refinance, there's also another 3 days at the end for right of rescission. But on a purchase, you can fund the day of signing if you're in good shape, or the day after. Does that answer your question?
I think that's great, Cal. I think the only addition that I might make would be thinking about where it might not. So Cal's described an ideal process, right, where things go very quickly. And that works most of the time, but there are times where it doesn't. One of the areas where it doesn't work as well is on jumbo loans. Jumbo loans have a little bit more of a, I'll call it a traditional process. The technology has not made it all the way through. As technologically advanced as you may think lenders are, the reality is that we are actually pretty far behind in terms of all sorts of automation and technology. It's getting better, and it's getting better quickly. But the jumbo space is one area where it's not moved very rapidly. So you're still waiting sometimes a couple of days to get disclosures out. We submit them, we have all the fees from escrow, like Cal said. It might take a couple of days for disclosures to get out, and it might take a couple of days for the appraisal to be ordered after that. So that would be the only deviation. And you're going to know, ideally, you're working with a lender that's doing what, Cal? They are communicating. Communicating
with you. And yes, John is completely right on jumbo loans. Now, things can always change. It wasn't really, the jumbos weren't this challenging months ago, but today we're finding that, and a jumbo loan, for those of you that want to know, there's 3 different loan areas. You're there, and this is for the LA County. I also want to, so this will bring up another good point that we're learning as we go through, right? So for the most part in LA County, you've got your conventional conforming loan, and that is any loan $510,400 and under. That's where you're going to see your best pricing, your easiest underwriting, and your simplest guidelines. Then you've got your high balance loans, and those are the 510,400 all the way up to 765,600. And those 2 rates are good. Guidelines a little bit rougher, but still good. And underwriting times are still good, not as good as the 510, but better. Then you've got what we call your jumbo market, and that's 765,600 and over. I think I can tell you that when COVID hit, everybody fell out of the jumbo market, including the big banks. They were in the middle of refinances and purchases that they just froze. Some of you may have had that experience. And so they've been a little bit harder to do these past couple of months. It's coming back, we're back, but like John said, it's a manual underwrite where a lot of things aren't being done with our amazing technology. And so, yeah, the turn times are a bit different. But again, I'm very optimistic, John's optimistic. As long as there's communication, we know the turn times up front. Our lenders tell us. They say, this is our turn times. As long as you follow it and you know how to stay on top of it and the communication is there, then I think your borrowers will be happy. But those are the 3 different areas of lending. Now, I do want to caution you, because like Rancho Cucamonga, the San Bernardino, it's becoming more popular for our clients to go out there and purchase homes. It's shocking how many loans, John, how many in the past 2 weeks have we gotten because a lender forgot to tell the client that in that area there is no there is no high, I mean, you got to stay at 5'10", 400 and under. That is their high balance arena. So again, it's education and communication.
Yep.
Okay.
So, when people ask kind of what are the 4 keys before you buy, it's pretty straightforward. You get it, right? So you got to have a steady job and income. You need to be paying your bills on time, all bills on time, as you say, right? Have a decently established credit history, and of course, have some money kind of saved up. It's still remarkable how many people come to us and are missing one of those 4 keys. But that's fine. If you're missing the keys, that's great. We'd love to talk to you anyway. And then we put together what we call a home loan action plan, right? So pretty straightforward. And we can help people. We've had people come back, years after we've first talked to them, and they get in a home, and that's a wonderful experience.
John, before we go on, do you want to just quickly, since we are in COVID, and I'm getting a lot of questions, not from this group, but from a lot of agents about what happened when a lot of lenders gave people the option of not making their payment for 3 months and putting them in forbearance. How are we seeing that affect our potential new buyers and new homeowners?
Well, so if they're a first-time home buyer, then they obviously didn't have a mortgage, but they might have made a decision to take a forbearance on a car loan or student loans or something else.
Right.
And to the degree that you're having the conversation with your clients, encourage them not to do a forbearance on anything. Right. The guidelines were really stringent. When it first happened, they came out and said, if you chose a lender forbearance on a mortgage or anything else, you weren't going to get a mortgage. Or then about a week or 2 after that, it became, well, if you had a forbearance, as long as you catch up on all your missed payments, you're okay, you're good to go. And then sort of as time has evolved in the last, call it month, it's softened up a little bit. However, you may have to prove that you didn't do the forbearance. So a lot of people didn't do we've had it happen where it's been on their credit report that they did a forbearance. Some of the large banks, like you might imagine the names that are out there, just automatically
happy to say.
we won't say those lenders that are great lenders, but they tend to make some errors at times here and there, and they just automatically put people in forbearance. And people didn't want the forbearance, and so now it's on their credit report, and now they got to prove that they made their payments on time. So the impact may be long lasting. The reality is this might go on for another, well, however long it goes on for in the forbearance activity. So anyway, bottom line, if your clients can afford to not go into forbearance, they just want a free ride for a couple of months, don't do it. It could be negatively impact you somewhere down the road, especially if you want to own real estate. Okay. So that brings us back to why. I mean, and we always circle back to where we started from. So why do you want to buy a home? Ideally, when you're going through this class, you're a smart home buyer. You may be a first-time home buyer. You're going to think about it. So what are the reasons? And some of those reasons may have changed as you learn more. So you always come back and circle back and ask people what's important about it. We have a unique process that we take our clients through, a 7-step process on getting the right mortgage, and we won't spend a lot of time on that, but there are the 7 steps. And Cal, you can chat about our home loan action plan.
I am, but I'm going to tell all of you here on the call today that John co-authored a book called Borrow Smart, Repay Smart. And so if anybody wants a copy, I'll make them sign it for you and I'll mail it to you.
It's not coming through very clearly. I don't know why.
If you're interested, it's pretty good. And he did a good job on that. So if you're interested and want a copy, let me know and I'll send it out to you. We talked about this earlier. So maybe the clients are not ready to buy today, tomorrow, but they will eventually be ready to purchase a property. What we do for them, it's why we like to talk to them a few months before you're actually going to get out there and start showing them properties, is we create what we call the home loan action plan. And by the way, we do this because we love education. Like you, we only get paid if we close a loan. But this is important for them to know because I'm going to be honest. We have many home buyers that we've worked throughout our career. I've been, like John said, with him 11, almost 12 years now. And some of my favorite clients are those people that came to us that just wants the dream of owning a home. And they ended up in a $250,000, $300,000, $400,000 home out in Rancho Cucamonga. But when they came to us, they could barely afford their $1,200 rental payment and thought, I will never be able to buy a home. So not true. Within 6 months to a year, because of our home loan action plan, they were able to purchase a property. It becomes more real. So we get it, you know, what we do is we talk about where you are today, we talk about their income, we clean their credit, we tell them how much money they need to realistically save for their down payment, those other costs, and maybe a little emergency fund. We talk about what they can afford, the suitability, and we talk about the different loan programs and how to avoid the 5 most common mortgage mistakes. And we create a clear timeline for them. So if you have any clients that might want to take advantage of that, let us know. And
that's it. We're at the end.
Guys. Any more questions? I want to copy my name.
Yeah, I put in the chat.
What I'm going to do to make this a little easier, I'm going to put my email address in the box here.
So as Cal's putting that in there,
and I want you to, sorry, email me if you want the book. If you say your name, here's my email, my address, I want the book. And then if you want any notes or what have you.
The slide, and we'll send you the slide. We'll send the slides out, yeah.
Yeah, it's recorded, sure.
It's recorded, and as I said in the chat, we'll send out a copy of the presentation. Happy to do it. There's nothing proprietary. The more people that learn and understand, the better.
Of course. Is there anything else that I miss? Any questions? Oh, you already answered the if there's a bigger tolerance.
Yep, we got all that. I think I'm caught up on the chat.
I think we got it all. Anybody have any more questions? Well, then John and I are going to say thank you. We're going to say stay safe, healthy, and keep happy, guys. Stay positive out there. And it has been our pleasure. We love Arcadia. Love Arcadia. Talk to y'all soon. Bye.
Bye.